US dollar steady after jobless claims opens door for Fed easing in December. The US dollar, USD, is trading flat on Thursday at around 106.50 when tracked by the DXY US dollar index, after New York Fed President John Williams said that inflation continues to cool down, opening the door for a further drop in interest rates. The US dollar has traded broadly sideways in recent days, influenced by swings coming from the war between Russia and Ukraine and, more recently, disappointing earnings from Nvidia. The U.S. economic calendar features on Thursday the weekly jobless claims data, and the Philadelphia Fed manufacturing survey for November came in under expectations. In the jobless claims, the continuing claims part is starting to near the 2 million head count. Meanwhile, the Philadelphia manufacturing number for November fell in contraction and adds weight to the call for a rate cut in December. Daily Digest market movers, U.S. data softens. New York Fed President John Williams delivered some dovish comments. Williams said that inflation is heading lower and interest rates should fall further. Fed's Williams meanwhile received additional support from Richmond Fed President Tom Barkin, who said in an interview on Thursday with the Financial Times that inflation will continue to drop, Bloomberg reports. On the geopolitical front, Ukraine reports that Russia has launched a ballistic missile, Bloomberg reports. At 13:30 Greenwich Mean Time, the weekly jobless claims for the week ending November 15 came in at 213,000, lower than the expected 220,000. Main concern though is the surge in continuing claims, where the headcount is jumping to 1.908 million people against 1.872 million last week. The Philadelphia Fed manufacturing survey for November tumbled lower into contraction by -5.5, substantially lower than the +8 and 10.3 seen previously. Existing home sales data for October jumped to 3.96 million units, beating the 3.93 million expectation and the previous 3.83 million. A batch of Fed speakers are due this Thursday. Near 13:45 Greenwich Mean Time, Federal Reserve Bank of Cleveland President Beth Hammack delivers welcome remarks at the 2024 Financial Stability Conference organized by the Cleveland Federal. Hammack will speak again at 17:30 Greenwich Mean Time at the same event. At 17:25 Greenwich Mean Time, Federal Reserve Bank of Chicago President Austin Goolsbee participates in a moderated Q&A session at an event organized by the Central Indiana Corporate Partnership in Indianapolis. Federal Reserve Bank of Kansas City President Jeffrey Schmid delivers a speech about economic growth and monetary policy at an event organized by the Fairfax Industrial Association in Kansas City at 17:40 Greenwich Mean Time. Federal Reserve Vice Chair for Supervision Michael Barr closes off at 21:40 Greenwich Mean Time, participating in a discussion about banks and artificial intelligence at the 2024 FinReg Lab AI Symposium in Washington, D.C. Equities are whipsawing through the day between gains and losses. The Nasdaq is the main loser, down near 0.5%. The CME FedWatch tool is pricing in another 25 basis points, BPS, rate cut by the Fed at the December 18 meeting by 55.5%. A 44.5% chance is for rates to remain unchanged. While the interest rate cut scenario is still the most probable, traders have significantly pared back some of the rate cut bets compared with a week ago, when a rate cut possibility was still at 72%. The U.S. 10-year benchmark rate trades at 4.38%, sliding further away from the high printed on Friday at 4.5%. U.S. dollar index technical analysis: stay away if you can. The U.S. dollar index, DXY, is supported by the constant safe haven inflow on the geopolitical tensions escalating between Russia and Ukraine. Traders should keep in mind that if the recent escalation eases and both parties head into any kind of ceasefire talks, the greenback could retreat. After a brief test and a firm rejection last Thursday, the 107.00 round level remains in play on the top side. A fresh yearly high has already been reached at 107.07, which is the statistical level to beat. Further up, a fresh two-year high could be reached if 107.35 is broken. The first level on the downside is 105.93, the closing from November 12. A touch lower, the pivotal 105.53, April 11 high, should avoid any downturns towards 104.00. Should the DXY fall all the way towards 104.00, the big figure in the 200-day simple moving average at 103.95 should catch any falling knife formation. US dollar to Japanese yen price prediction: trading within a possible bearish broadening formation. US dollar to Japanese yen could still be in the process of forming a broadening formation pattern with bearish potential. If so, then it is likely to eventually decline towards the lower boundary line of the pattern at around 151.50. Following that, it could even break below that line and decline to the projected target for the broadening formation, BF, at around 148.54. US dollar to Japanese yen has overshot the upper boundary line of the BF, and this could either be a sign of exhaustion of the uptrend or a sign of bullishness. It is possible the pattern could be false, and in that case, US dollar to Japanese yen would still be in a strong medium-term uptrend. If so, given the technical analysis principle that the trend is your friend, the odds would favor more upside. In such a case, a break above 156.25 would likely confirm further gains towards the target at around 157.86, July 19th high. US dollar to Canadian dollar holds key support of 1.3950 as US dollar resumes upside. The US dollar to Canadian dollar pair ticks down but holds the immediate support of 1.3950 in Thursday's North American session. The loonie pair strives to resume its upside journey on the US dollars, USD, firm near-term outlook backed by growing doubts over whether the Federal Reserve Fed will cut interest rates in the December meeting. The Fed started its policy easing cycle with a 50 basis points, BPS, interest rate cut in September and took forward the process to this month with a 25 BPS interest rate reduction. However, traders seem to be indecisive about the continuation of the rate cut cycle for next month on expectations that the implementation of President-elect Donald Trump's economic agenda will boost United States, U.S., inflation and economic growth. The US dollar index, DXY, which tracks the greenback's value against 6 major currencies, ticks down in the North American session to near 106.50 after the release of the initial jobless claims data for the week ending November 15. The greenback drops even though the Department of Labor reported that individuals claiming jobless benefits for the first time came in lower at 213K than estimates of 220K and the former release of 219K, upwardly revised from 217K. In the Canadian region, traders have reduced some bets supporting a second consecutive larger-than-usual interest rate cut of 50 basis points, BPS, by the Bank of Canada, BOC, in the December meeting. Market speculation for the BOC 50 BPS interest rate cut diminished slightly after the faster-than-expected growth in the Canadian Consumer Price Index, CPI, data for October. The CPI report showed that the headline inflation rose by 2%, faster than estimates of 1.9% and the former release of 1.6% on year. For more cues about the likely interest rate action in the December meeting, investors will pay close attention to the monthly Canadian retail sales for September, which will be published on Friday. Economists expect retail sales to have grown steadily by 0.4%. US dollar to Canadian dollar, short-term trend momentum weakened to near neutral levels, Scotiabank. The Canadian dollar, CAD, is little changed on the session. Soft stocks contrast with generally firm commodities on the session while short-term cash bond spreads are narrowing somewhat, Scotiabank's chief FX strategist Sean Osborne notes. CAD drifts back to the mid-1.39. Mixed short-term impulses for the CAD and limited domestic data releases, industrial product prices this morning, leave markets with little to go on in terms of the CAD's direction. Crossflows, euro to Canadian dollar below 1.47 for the first time since July, may be giving the CAD a little support, but even mild US dollar to Canadian dollar losses leave spot straying a bit more conspicuously from estimate fair value, 1.4032 today. Short-term trend momentum has weakened to near neutral levels following the USD's drift back from its early week peak. Spot continues to find support around 1.3950/60, but there are some tentative, CAD positive signs on the weekly chart, with the USD failing to hold last week's break above 1.4040 resistance at this point. USD weakness below 1.3950 could see spot ease back to the mid/upper 1.38s. Resistance is 1.4000/10.